Every
Let me just one thing.
Okay, I just started recording. Good to go. Very good. All right, everybody. We have another wonderful presentation with myself, the house. See some newcomers. Hey, how are you? How's everything? Good to see you. What's your name, man?
Hey.
Hey, Norberto. How are you? Very, very good. Today, did you want to say anything to start?
Nope.
Okay, very good. All right, so today we're going to talk about credit. Credit is obviously unbelievably important, but not just for your clients that are looking to buy homes, but honestly, this is actually I do a lot of credit training and presentations in general, just because it affects all of our lives. And if it doesn't affect your life, if you have an 800 credit score, probably someone you know does not. Maybe your kids, your cousin, your sister, your brother, your parents. Credit is very important to understand, know, and use correctly, because if you don't have good credit, it affects you in so many ways. And you want to have good credit at all times, because if anything does happen in life, which no one escapes from, life gets all of us at some point, the stronger your credit is when something bad happens, the more you'll be able to break through it. Maybe your score will be a little low, but it's not going to be terrible. Having high credit gives you lower rates, more options. It may decide whether or not you can get into a house or an apartment.
Lower rates for mortgages?
Mortgages, homeowners insurance, car insurance.
Really?
Auto loans. Yeah.
Credit cards.
Credit cards. Well, credit card, it doesn't necessarily affect your rate on a specific credit card. Usually the rates are baked in, but it decides which credit cards you can get.
Okay.
Okay. So if you have terrible credit, maybe you need a secured credit card that you have to actually have a deposit for ahead of time. Whereas if you have really good credit, you can get a lot of points and mileage and rewards. I'll tell you that my wife and I, we, when it comes to holiday time, we get gifts for all the kids and the extended family from our points alone. You just cash in on the points. So we don't, we hardly pay for anything. I mean, it's accumulated. We could choose to use it on anything we want. So it's not like the gifts are free necessarily. But if you actually focus on your points, it's free money. And a lot of people don't focus on their points.
So points come only with specific credit cards?
Yeah, not all credit cards necessarily will give you the points or Sky Miles, but a lot of them do. You don't really see them on like the starter credit cards as much, but on the bigger ones. But just in general, credit's important. And maybe you've had a client before that you wanted to help get an apartment, you wanted to help get a house, but the credit's terrible. And guess what? Now they're stuck, right? So that's why I say, even if you're not getting a house right now, even if you're not getting an apartment, you always want your credit to be as strong as possible, because if something does go wrong, it won't hurt you as much. Let's say you lose your job and you miss a couple credit card payments, and now you have to change apartments. Having a stronger starting point may decide whether or not you actually can get a new apartment or not. So credit's important.
What is this slide?
So this slide, this is the only one we need to go over from the presentation. But I wanted to show you guys. Yeah, well, it does come out looking that way. But it's a great illustration in general, because it explains very clearly what the most important factors are, and just knowing this alone helps in a huge way. Hey, how are you? Hey, how you doing? So that being said, why don't we break into it? So what determines what our credit score is? So usually I'll do a little hot quiz at this time, but I already have it up. So, but a lot of people think that credit.
I was going to say, I can't see that far, so.
Don't worry, I'm going to go over it.
So this is still new information.
Sure. Well, listen. So raise hands here. Everyone here probably thinks that the credit is dictated by whether you pay on time or not, right? And it is.
I think that's a big myth.
Well, that is a big myth, because a lot of people think that's everything. And there's a lot more myths than that. I'll tell you, when I grew up, I grew up before Google, right? But what I used to hear, the things that I would hear help out with your credit scores do not, right? And honestly, they are complicated algorithms, but I would say if they did, it would be to a nominal amount so insignificant that it doesn't matter. So I used to hear, if you pay your credit cards early, or if you pay more than minimum payment, or if you pay more than your minimum payment.
That one I've heard. People think if they pay more,
right,
it's going to be better.
And I guess technically it could, but it's indirect. It really just depends on what is the impact to the balance? How much more are they paying? So let's actually break it. We'll break it down. Okay. So according to this pie chart here, 35% of your credit score has to do with on-time payments.
Okay.
And I guess I should actually rephrase that into only 35% of your score has to do with on-time payments. Normally when I do this pop quiz, people think it's 80%, 90%. It's basically only 1/3 of your credit score. That is powerful knowledge in itself, because the second most important factor is what's called the utilization ratio, or to make it simpler, balance to limit ratio. What is your credit card balance relative to your credit card limits? Okay, so let's say, for example, I have a $10,000 credit card. Many people, my clients included, would think that if they have a $7,500 balance on the credit card, that's no problem. They have another $2,500 left. They're nowhere near, in their mind, maxing out. Definitely have never gone over. Always paid on time. Then we take a look at their credit, and their score is lower than they're expecting, and they just can't figure it out. I never maxed out my credit cards. I pay on time. I pay early. What's going on? Well, having a 75% utilization ratio, or your balance being 75% of your credit card limit, is bad. Okay.
How much of it should you use?
Great question. The optimal is 10 to 15%, but
that's it.
But over 30% is, well, actually, I'll give you some tips there that'll help out with utilizing more of your credit cards. But once you go past 30% is where we start to see the nose stuff. So if you have a $10,000 card, I would suggest in your mind you have a $3,000 credit card, and that's how you have to treat it. You don't have a $10,000 credit card, you got a $3,000 credit card.
Okay.
But that's okay, because you can bring it up.
That's good too.
It's extremely important. And if you keep, like I said, maintain this strategy, you will be able to increase your limits. Okay, that's another big tip we'll go into.
I have a question. So you can increase your limits. So
Yeah.
let's say you have a 10,000 max on a card. You're only using, up to 3,000, but you're always paying it off. How can you increase is the credit card company going to say, hey, I'd like to give you another?
Sometimes they do. Sometimes they do. But that's actually not what I would suggest. In fact, when I do my credit classes,
I have a question.
Yeah.
Because I'll forget. If
Sure.
they give you more, if
Take
they
it.
give you another 5,000,
take it every time.
then theoretically you could probably go up to 4,000 or
100%.
okay,
So,
and still maintain
yes.
that's good.
In
Credit number.
yes, it's so important, and I'm actually glad we're kind of delving deeper into this. It's so important to understand when it comes to the utilization ratio, which is huge. It's basically just as important as paying on time.
And I had no idea.
Most people don't. Most people have no clue. In fact, sometimes I can fix people's credit extremely quickly in a matter of weeks, simply by paying some things down. That's it.
And keeping it within that.
Yeah, well, until I run the
30%.
credit report again.
Okay.
But if as a life style behavior, keep them low at all times and just focus on increasing your limits, which I'll tell you how to do.
So if a credit card company asks you, hey, we would like to increase your limit, you should always say yes.
Absolutely.
Because then you're 30%.
100%. If they're willing to increase your limit, always take the limit increase.
Say yes.
Absolutely.
It will help your credit score.
Absolutely. And listen, some people would say, well, if they give me more, I'll take more. That's an entirely different problem, right?
Right.
This is understanding credit and using it as a tool. Okay. Credit can hurt you. Credit can help you. It can help you literally open doors into your new apartment, your new house, your new car, or it could shut you out from all of those if you don't treat it correctly.
Which of these did we just discuss?
So we're discussing the 30%, and let's actually stay on that because these are really, really the big ones. So when it comes to the balances, in answer to your question from before, if you have a $10,000 card, we want to keep that balance no higher than 3,000. But if you do increase it, okay, now you've increased it to 20. Let's say, okay, let's say you were doing so good that you were able to increase it to 20. Well, now your new mental limit is 6. Okay, and if you have to go over because you went on vacation, it's okay. Just try to get it back down to 30% as quickly as you can, or as close to 30 as you can. If everything in life is going swimmingly, then the optimal would be 10 to 15%. That would be perfect. But under 30, you're still good. You could have great credit under 30%. Okay?
I learned something.
Absolutely. Now, how do we increase our limits? Yes, we could wait for the credit card company to do this, but I've actually went down my personal journey testing this out myself. Here's what I found. For most credit card companies, you can ask them to increase your limits every 2 to 3 months. Okay?
Oh, wow.
Absolutely. You know what? Some of them may even allow you to do it quicker. What was that?
Do they do it if you ask?
Well, I will tell you that in a 2-year period, I brought all of my credit cards. I have about a dozen. From some of them were extremely small limits to extremely high limits, like from 500 to 30,000, 500 to 40,000. When I started doing it, I think my Lowe's card was at 1,000. I brought that up to 40,000, which is the limit for a consumer. I found out because they wouldn't let me do it anymore. It's actually really simple, super simple to do.
This guy keeps calling us.
No.
Let's just say no.
Well, that's the best part. You don't even have to call. It's unbelievably easy. When you go to your credit card website, there's always that magnifying glass, usually in the top right. You hit that little magnifying glass, you search for increase or, limit increase. Limit increase, it'll get the option. They have different terminology, but usually it's going to say increase your limit increase, whatever it may be. Then it'll usually say, how much do you want to increase it to? My suggestion, this is what I did for myself, is to do small increments. It was almost never where they did not honor. Like there were a couple times in that couple years, but almost every time they gave us more.
The increments, did they
No,
say, do you
not that
want
I've
to
seen.
increase 2,000, 5,000,
No, I don't.
10,000?
Well, the only suggestion would come is the times when I tried to make it higher, I tried to go for big jumps. It would say, hold on, maybe let's do a little bit. So my suggestion is if you have a $500 credit card today, try to increase your limits to 700.
I'm going to go home. I have a lot of homework to
Yeah.
do.
If you have a 5,000,
Not
try
that
to
my
make it
credit
7.
isn't good. My credit is good. But I'm going to go home and.
Well, yeah. If you,
Right? This can't hurt.
You're obviously staying consistent with it.
Well, yes. So yeah, just so we're clear, if you have a terrible credit score, especially with that credit card company, you're probably not going to get it. We should preface with.
You won't get the increase.
Yeah, usually what I tell people,
What if you
like
just
my own
ask for
clients, they may or may not, right? Your chances are much higher if you're paying your bills and you have good credit.
Yeah, chip away.
Right? And like I said, all increments. So don't try to go from a $500 credit card to a $10,000 credit card because they'll probably say no. And understandably, like they don't know what you're going to do if you got that much more credit, right? So if you have a 300, make it 5. If you have a 500, make it 7. If you have 7, make it 10. You know, just try to keep on going up a little bit because what I found is when I try to make it big, and this is great credit, perfect credit, paying on time, everything perfect. Still, they didn't let me go too high too fast, right? So just little bits, and I've helped a lot of my clients do this. I did this years ago. Since then, I've helped I try to help almost every one of my clients with credit, even if they have a 700. How can we get it to 750, right? How do we get that up no matter what? So they all try to do this. It's very, very successful. Try to inch up. Now, it's not all about the one increase, though. Just keep doing. Like I said, I did it for a couple of years until I just didn't have to because I had so much. There's no point. They're all so high now, right? So what you want to do is you just do it, and every couple months, I kept track of it. I have an Excel sheet. I even have a worksheet that I can even send out. I made some for some clients in certain classes. But basically, it allows you to keep track of when you're doing the increases, among other things. Keep track of your balances and your limits. And if you just focus on that in a very relatively short period of time, let's just say, even if you have terrible credit, if you focus on it and you work on it, let's just say for, a couple years, it can increase in an unbelievably rapid way. I've helped people that just had bankruptcies, just had short sales, foreclosures. A few years later, we're buying a house. Their credit's not that bad. I mean, it's not great, but it's not that bad.
So to that point, several years ago, I had a cousin that was still a cousin.
Sure.
And she wanted to buy a house, and she went through a divorce. And people get nasty, I guess, in unhealthy divorces, and supposedly, somebody wasn't paying the bills intentionally. Anyway, when she finally, when the dust cleared, she had really bad credit, but she needed a house. She was living with family. She had small children. So that was like her, midpoint. Of course, she wanted to get out on her own to buy her own house. So I knew how much money she had. She had a sizable down payment, but she just could, she said to me, my credit is so bad. And I said to her, without even knowing any of this, you need to talk to a mortgage rep, right?
Yep.
The first step is to get pre-approved and have someone look at, all of your financials. And she said, well, I'm going to wait. I think I've got to pay some things off, and I'm going to do this and do that. And 6 months went by, and I said to her, you have to talk to her. She kept saying, let's go see that house. Let's go see that house. Let's go see that house. And I'm not bringing her to any house because she's not pre-approved.
It's not good for her either.
I love her. She's my family, but I'm not wasting my time. I don't work for free. It's a waste of her time too. She doesn't realize it's a complete waste of her time. It's like driving somebody past a candy store who's got no money, and you can't go in and buy the candy. So I finally said to her, listen, love you, but you got to get to a mortgage rep. And she did. And again, this is really without a lot of this knowledge. She said to me, I should have gone 6 months ago.
Yes.
I said, it's just like talking to my kids.
I honestly say that all the time. We hear that a lot, where someone will say, yeah, like I'll get recommended to, maybe a past client, and they're like, I'm telling my brother about you, or telling my mom, my cousin, my friend.
But they think that they only need you when they really are going to buy. I'm saying they need you just to figure out where they are.
I'll tell you what.
Or to get to buy quicker.
I actually wouldn't say it that they think they need me then. I think what it is they're terrified of a couple things. Number one, who wants to hear that you're financially in not a great spot?
But I mean, in this case, she said, I know my credit is bad.
Right.
Okay, so
the second thing is a lot of them feel like they want to come back when it's better, because it's like they have an apprehension to either being told no, or maybe they think this is my one shot. I always tell people, listen, I'm on your side. As a mortgage lender, I'm on your side. If your score isn't good, then one of the things we're going to do is I'm going to help you bring that score up. Some people, you could imagine, let's just say right before she tried to apply for a new credit card, and as soon as she applied, it said, you are rejected. We'll send you a letter in 30 days. She gets a letter in the mail. It just says, your credit's crap. You're not, this isn't going to work out. This is no good.
This is
it's a rejection.
This isn't, a G-rated conversation.
Yeah, absolutely. but you know what? It's a rejection.
Yeah.
Right? So a lot of people, they're afraid of rejection, and
even though they need help, they know they need help. They're still afraid.
And I feel like sometimes they're like almost and it just is this is an apprehension and a concern I've heard a million times. And I feel like sometimes they feel like I'm the underwriter. Like, once I see that your credit is terrible, that's it. So yeah, for anyone you get rolling in early.
So as far as agents are concerned, they really need to know this to get their clients
well with the right person too.
And if it's not good initially, it's not going to be held against you, because you're going to try, get it up, be in a better position. No one's going to remember 6 months ago, hey, you were,
We have a question, but before you ask, I do want to just say one thing. It's super important. You definitely put them on the right path, but you have to send them to the right person, right? Because number one, besides the fact that, because they'll come to me after. Not even necessarily. Yes, I could certainly help, but I've literally had people come to me because the last person said, "Your score's no good. Come back later." Like, come back in 6 months.
Without telling them.
Well, they don't know.
So
you don't learn how to fix credit just by being a mortgage lender.
This is what's so important for us to know, because if we can't get them there, we're the ones that have to tell them that.
And right before a question, I do have one quick anecdote. I'll tell you this, and this is a great illustration of what could happen if they go to the wrong spot. Absolutely. So this is a true story. I once had, and I won't say what bank it was, but it's a bank, logo's green, and they came to me after. And there's
sounds like
so this person went to get free. This is so many years ago, but I remember, I'll still never forget it. He went to there. He spoke to the loan representative there, and here's what they told him. Okay, by the way, understanding how all this stuff works.
I have a point to that.
Sure.
Go ahead.
Just now that you already know more than this lender, okay, because this person had a lot of credit cards with high limits, low balances. This person did not know what they were doing. I cannot stress to you enough. You probably hear me say every time, just because they're a loan officer or a lender does not mean they know what they're doing any more than every realtor knows
Just
what they're doing.
because you're a realtor,
right,
doesn't mean
you know
any
works.
more than the next realtor. So to that point, and I know you said, you know, this bank, no names mentioned, I have clients like that, no names mentioned, but their names sound like, you know, their names I'm never going to forget. But people buy people first before they buy goods and services. So you want to, you know, go with someone that is knowledgeable, regardless of what green sign is outside of it. So, you know, that was probably a really good institution with a lousy employee who just was not well versed in really
I would
how
say
to help people.
I'd say a regular employee, because usually when I take over deals, because I built my business taking over deals from other lenders, to be honest, that were denied. Most of them were banks, and I'll tell you,
Exactly.
but I'll tell you in a nutshell. Now that you know this,
they don't know what you know.
100%. Well, yeah, because you know, you have to try, right? And you know, honestly, you don't really have to. It's a different world when you're at a bank. It's not the same thing. They don't even have the same license. It's a very different situation.
They don't have the same license?
No, it's like a registry situation. It's a little different with the bank. But the important thing is this. So now that you know what you know,
we needed to know
that
too.
30% is utilization ratios, and then you want to increase your limits. You have to earn those limits. You have to take time and work at it and keep your credit high, and you get the limits. This person had a lot of high limits. The person from that bank told them, hey, we're having an issue here. We can't pre-approve you because you have all this potential debt on your credit cards. And this is a real conversation. He said, well, he was talking to them. Well, what do you mean? Like, my balances are low. The lender said, yeah, but that's the thing. You could max out these credit cards and then you'll have huge payments. So that's a real big concern. And it can make sense almost, right?
That 30% of
No, this person did not know any of this stuff, right? The lender did not know anything. But he's advising him.
Oh, that's what the lender said.
That's what I'm saying. Yeah, the lender was from the bank was telling the person that he can't be pre-approved because if you max out all of your credit cards, you'll have really high payments.
And all of that was not true.
It wasn't true. And the person lowered all of his credit card limits to basically where the balances were, as he was advised by the banker. Then his score tanked, because he became maxed out on all of his credit cards.
And yet he thought he was doing the right thing.
Well, until his score tanked, then he spoke to his realtor and said, do you have someone who knows anything about credit?
Here's another thing. I get a lot of clients that say, you know, are you pre-approved? They say, no. Do you have a mortgage rep? They say, no, I've submitted with my bank. That has never really been a red flag for me before. But
oh, that's a red flag. Well,
now it is. I feel like now.
I'll tell you.
Coming from a different.
A bank is a huge red flag for multiple reasons. I'll give you just one because I know we're talking about credit here.
Nothing against the bank.
Yeah.
Green, because you're all stink.
But I'll tell you right now, I won't even go into the million reasons. But when it comes down to it, a mortgage banker or a mortgage broker, I'm a banker. I personally, there's really three routes: bank, broker, mortgage banker. I think the mortgage banker is the best one. I don't say the banker is the best one because I am a banker. I'm a banker because it's the best one, right? So the issue with almost every bank.
You need to know the differences.
Sure, yeah, and we'll definitely go into that. But just on a quick note here, when you're a lender and you're pre-approving someone, here's a big one. We go off of debt to income ratios, meaning what are your expenses relative to your income? That's one of the big three. It's credit, assets, debt to income. Those are the main three pillars. Obviously, there's a million guidelines, but those are the big three. So when it comes to debt to income, huge deal. Almost every bank is limited to 43% on, let's say, a conventional loan, the big loan. 70% of the loans in the country are conventional for the most part, right? So let's put it this way. Let's say you make $10,000 a month. Very easy income. That's a couple making $60,000 each, or one person making $120,000 a year. Both easy scenarios, right? If you are making $10,000 a month, 120 grand a year, then your expenses, if you go to almost any bank, maximum is $4,300 or 43% on a conventional. It's called a qualified mortgage rule that they are subject to. Some, like the one we were just talking about, is 41%. So let's say you have a client.
But is that also your number, or are you just saying the bank?
No. Banks in general are limited usually to 43%.
Okay.
Okay. I can go to 50%. Okay. So the bank
But
I was
you
just
are a
telling you about,
banker.
I'm a mortgage banker. It's different than a
Okay.
depository bank.
Okay.
So we're like a bank, but we have our own money, we fund our own loans, but all we do is mortgages. We don't do coin machines
Deposits,
and CDs and
savings.
IRAs. Yeah, it's just mortgages. So we have more products. We're able to do way more. It's just different.
But
It's
not to
night
get
and
off
day.
task, you can go up to 50%.
Yeah, and to put that in perspective, $100,000 in a
Expense
mortgage
to
loan
pay.
today costs about $650 a month. So if you're making $10,000 a month, a very normal salary,
You're already over.
for one or two people, let's just say your expenses to buy such a house is $4,300. Okay, you're approved. So let's say your client that went to the bank, their maximum price of a house is $500,000. Okay, if even with the minimum down payment,
based on their
let's just
income?
by the debt's income. Let's just assume that they went to a bank and they were told their max is $500,000 on a conventional loan. Most likely, however they got to there, if they did their calculations correctly, if they're limited to 500, I could probably go over 6 right off the bat.
Comfortably without really stressing the client, should they
It's just the
find the
base
house
guidelines.
that's for 6?
Yeah,
buy
what happens is
They're not gonna be
these conventional loans, there's a guideline book that we all follow, but banks put on additional rules that we call
tighter
overlays.
restrictions.
All types of restrictions. Credit score. Like some banks, you can't do the loan unless they have a 660 score, 680 credit score. I just got an offer accepted for someone that has a 588 credit score. We're doing this loan. I'm going to close in 30 days. Just this morning before I came here, 588 credit score, I can do that. Okay. Oh, I don't know any banks that can do 580, right? So we can do the base guideline books. So other people can do what I can do, but no one can do more than I can. But we can do way more than banks if they have additional things. So not to get too much on a tangent, but that's just one huge reason why you don't want to work at I would never work at a bank, for mortgages. No way. But just to, cap that off, and there's other reasons too. We'll do a class on that one day.
I feel like we're in the middle of things. Did we finish this high?
So let's talk about, all right, so just to finish the 30%, okay? Try to keep your balances low at all times, limits high, and, just to touch on what I originally said, which is keep your credit strong at all times, whether you're buying a house or forget about it, always keep it high. Why? Because just like you said, you had someone going through a divorce, now they're missing mortgage payments. If she had a bad or okay credit score to start, then once you miss a mortgage payment, it's gone. At least if you had an 800 credit score, which everyone can have, it's not like super difficult if you just know what to do. Then at least if you have some dings, I mean, mortgages they held a lot of weight, but let's just say they miss credit card payments, maybe their score won't be tanked. Forgiveness is really tough. No one wants to hear that. I'll be honest. You can't really remove lates because of a divorce. They don't really want to hear that. You tried.
Can you change the
Yeah.
I feel like the air conditioner. Sorry about this. The TV land.
Oh, and you know what? While you're doing that, Jess,
well, I can ask my question anytime. I think it'll tie in. But when Anne Marie was talking about her cousin who didn't want to get the credit help, I just thought about all the times that we have realtors sometimes that'll have a client that doesn't want their credit at all. No, don't run my credit. But
yeah,
let's say.
So that's a good question, and because I will lose my train of thought because there's so much information. But people think that if you go to a mortgage up, so I don't want to ruin your.
No, I think you're about to tie in my question. Actually, go ahead.
They think that if they go, it's going to be a hit.
Oh, that
if
was
they
my
get
question. But yeah.
pre-approved.
I'd love to talk about that.
Well, my question was actually, say they don't want to have their credit run at all, right? But you happen to know that they just checked out getting a car the other day, and they know that credit score. I know we use different matrices for car credit and home credit. Is there a average in about where if you can look at client's credit, they don't want you to run it, but the car company just came back with a 780. Can you give and take about like, all right, if
Like
the
what's
car
the
matrix
relevance
is
of
between
780
both,
goes the
mine
house
might
and the
come in
car?
760, 20 points lower.
It's
or higher.
typical. I mean, I'll tell you,
Just so you know, it's
auto
not
scores are
26
usually a good amount higher, to be
Higher,
honest.
okay.
Autos?
We're talking about a few different things here.
Yeah.
So let's actually address all of this. It's great. It's great question. So number one, so we're going to talk about the different credit scores. We're going to talk about
And how they're relevant,
yeah.
right?
So
Yeah.
well, let's talk about the inquiry part. Okay. So a couple things there. An inquiry, I'm sure we all know what a credit inquiry is. If a lender runs your credit, right? Up until a few years
Are
ago.
they being hit with some, are they being hit with some deficit because you're looking
Well,
at-
that's so not really. So let's talk about it. If this was a few years ago, everything I did was hard. Okay. You may have heard, if anyone knows anything about credit, you know, you may have heard that if a lender runs your credit, it's a hard pull, but if you run it yourself, it's a soft pull. The distinction is that a soft pull does not put an inquiry on your credit, so no ding to your credit at all.
Okay.
So now, and this technology is kind of going across the board in any finance or creditor world, everyone's doing soft pulls now. Okay, so getting inquiries on your credit report is not something that has to happen when it, like even when you do credit increases, sometimes they used to put a hard pull. You're probably not even going to see that anymore. So we do a lot of soft pulls. So I will not run someone's credit when I first pre-approve them. I'm going to do a soft pull. Okay. There are certain cases when I have to do a hard pull ahead of time of pre-approval, but it's
you'll
rare.
let them know.
Yeah, of course. Yeah, I would never run someone's like put an inquiry on them without letting them know. So just to address that, it does not have to be a hard pull. Moving on from there, what if I did have to do a hard pull? Is that a big deal? No, it is not a big deal. Number one,
another myth.
yeah, you're
just
gonna need the
busted.
hard pull anyway.
Everyone's so afraid of that.
I blame the simulators out there. There's a lot of, and also these other credit scores. So to understand why, well, let me put it this way. Let's start with the end. If I put an inquiry in your credit report, it's probably going to affect you 1 to 3 points. It's also necessary if we're submitting the loan. So if I do a soft pull now and then you find a house next week, I got to do a hard pull, right? So it's going to happen anyway. It's going to happen.
That's going to
right? It's going to happen anyway if you're doing it. The problem is some people think that the inquiry is devastating for some reason. Like they lose 20 or 30 points. Now I have some ideas as to why. Some of it has to do with correlation not being causation, if you've heard that old expression. Another reason is, because I've seen it myself, would be simulators. Like if you have one of your credit card companies like Credit Karma or one of those simulators and they say, oh, you just got an inquiry, your score just went down 20 or 30 points. That's not how it works at all. Like a late or like a max out credit card may bring down your score 20 or 30 points.
But your
Not an
hard
inquiry.
hit is not more than 3 points?
Yeah, 1, 2, it's basically inconsequential, right? Especially, and I always tell people, listen, I help people bring up their credit scores for a living. So if I bring your score down a point or two, don't worry, I'm going to bring it up 20 or 50, So, my clients, I usually don't have too much of an issue with my
Good
clients in the credit.
information.
But I'll tell you this,
We need to share.
couple things. Number one, there are dozens of different credit scoring models. A lot of people sometimes someone will say, oh, I just got this from Credit Karma or my credit card company, or I went right to Experian itself. I went to Experian.com. This is my credit score.
We recommend 3
Recommend 3 what?
credit companies, especially so getting into the world of real estate rentals. If the landlord puts in the listing that part of the requirements is that the prospective tenant needs to pull their own credit report. We usually say either Equifax, Experian, or TransUnion.
Gotcha.
Those
Okay.
are the
You know
top
what?
3.
I'm actually glad you said that. So I want to clarify. So we're talking about different things. I'm talking about credit scoring models. You're talking about credit bureaus. Okay. So, and there are other bureaus too, but the main 3 bureaus, meaning the private companies, they are repositories for our credit information. They get paid by the creditors and they get paid by the consumers.
Okay.
They are simply a storage facility of information. They collect data from the creditors. Even the credit card companies will pay these credit bureaus to display the information for lenders. Why does Amex, why does Discover, why does Visa, why do they pay the 3 credit bureaus to maintain and hold our information? To incentivize consumers to pay their bills. Because if credit wasn't a thing, who would care if they were late? Just pay it when you got it. No big deal. They'll send you a letter. Who cares? The credit reports make it an incentive to pay our bills. So the creditors and consumers alike will pay the credit bureaus, and they are just repositories for information. Now, these credit bureaus have different models of how to formulate a score. It's the same data. This person has 5 credit cards, 2 cars, and a house. Same data, but with one model, it may, so let's say you're looking to buy a car, right, different formulas, different algorithms. Now, why would you need that? Well, they're usually between 350 to 850. Obviously, the higher, if you're a 700 or 800, regardless of the model, that's good. If you have a 500 or 600, regardless of the model, that's not good.
But
now,
tying back into Jess's question, isn't that the difference between what formula you might use?
Well, you were getting to that. So
for a house,
well, for a house, we use the mortgage score always, right?
Versus a vehicle.
Yeah. So what she's asking is, if you know, well, let's establish that there are, right? So there are different models. If you were to go to 20 auto dealerships today and run your credit, let's say all 3 of them, Experian, TransUnion, Equifax, you'll have the same score. But then you come to me, I'll have a different score. Because this is a mortgage score. There's also a credit card score. There's insurance. There's all types of credit scores, okay? The ones that we use are mortgage scores. Now, why would it be different? Well, buying a 3-year, a $30,000 3-year loan to get a car is different than getting a $500,000 mortgage loan that you pay for 30 years.
So
there's different strengths.
My credit card bill comes in and it says, Ann, you're 787.
Mm-hmm.
I bring that to you and you're like, you're not taking it.
It could be. I'm not going to use it or anything. But.
Right, but that is, you're saying, like a credit card score. Essentially, it's not.
Yeah, I mean, most likely it's a credit card score. Yeah, it's not for a house.
Well, it came from the credit
card.
Right.
Yeah,
it's
yeah, most likely. Yeah, it just depends on what model, because like
really
there's different ones.
Could not be the number if I'm trying to get pre-approved through you.
Well, I'll tell you where you could see it. Like, for example, I have the paid service for Experian.com, and it's really interesting because they'll give you 4 scores. They give you the Experian score that I don't even think anyone uses it. It's just like a model to give you an idea if it's high or low. But if you have the paid version of Experian.com, you can hit other scores. It will give you your mortgage score, your auto score, and your credit card score. I tested it on myself. I did the other score. I put an inquiry on my own credit before the software was. I put an inquiry on my own credit, and it was the same exact score. Okay, so they do. You are able to at least Experian.com. I don't know if the other 2 will do it. I just use Experian, but it is exactly the same. The mortgage score that they can give you, if you have the paid service, it'll give you 4 scores, not just 1.
Okay.
Like auto, credit card, mortgage.
Could you get on to, www.experian and get these 4 scores yourself, or do you have to pay for it?
Well, you have to pay for the additional scores.
Okay.
You have to pay for the service. You can have a free account.
Do you remember how much? Roughly, is it expensive, or is it just like a?
It's not super expensive. I mean, nothing free. I mean, I don't know. I've been using that for like 15 years. I think I'm locked into like $12 a month or something. It's probably like 20 or something like that now.
You think it's under $100 if someone wants to?
Oh, 100%. No, it's probably like closer to 20 or something like that, maybe 15. I'm not 100% sure, but it's
Good
definitely
to
not
know,
100.
right? For 20 bucks.
Yeah, 20, 30. I don't know. Prices have been going up with inflation. I'm locked in because I've been with them forever.
And this is your thing.
Mm-hmm. But just to come full circle, the other reason why people think that inquiries are really bad is because it was an incorrect analysis of the scenario. I've heard the same thing a million times. This person ran my credit and my credit score was way lower. And I said, man, that inquiry ruined my credit. That's not what happened, okay? One of 2 possibilities. Number 1, it's a different credit model altogether, right? Just like we said, if you get 4 different scores from Experian, there are 4 completely different scores, right? So if you're getting this one,
different purpose.
yeah. So let's say you went into an auto dealer and then they ran your credit, and then a month later you go to a mortgage lender to get pre-approved. Now your score's 50 points less. You're like, man, this mortgage lender just ruined my credit with this inquiry. But that's not what happened. It's a different model. Second, your score is changing all the time, because the more accounts that you have, the more changes that could happen, right? So for example, your credit reports, they get updated usually once a month. What do I mean by that? Remember when I said that even the credit card companies pay the credit bureaus to update the information to incentivize us to pay our bills? Well, they're not going to do that every day. Why would they pay every day? They'll do it once a month. Usually when your credit card cycle is over and you get the statement, it has the balance, that's the balance that will show up on your credit report. Now, if I ran your credit right now and I have a credit card balance, if I run it tomorrow, it probably will be exactly the same, even if you've spent more or less. And it probably wouldn't even be the balance that you had today, because it could be that, let's just say your American Express updates the credit bureaus every 7th of the month. So if we make a change or a payment or we buy something on the 6th, and then it's updated on the 7th in the credit bureaus, if I run your credit on the next day, it'll be there because that's when they update, right? But let's just say that they update the credit bureaus on the 6th of every month, and I buy something for $10,000 on the 7th. Well, for the next 29 days or so, 30 days or so, I can run your credit over and over. That purchase will not show up in the balance because it hasn't been updated. So if you have 10 credit cards, just imagine that as you're going through the month, your balance is going up, your balance is going down. The higher it goes, your higher utilization ratio goes, the more it can ding your credit down. When you make a payment and it updates the credit, your score can go back up. So if you have a bunch of accounts, your score is changing all the time, especially if you're making big payments. So there's a lot of business owners out there, especially, that will, I was just talking to one yesterday. She spends around $50,000 a month for her business. It's a retailer. So now, at one point in time, the credit card, depending on this credit card, when it updates, it could have a $60,000 balance, it could have a $10,000 balance, okay? Right. Because she'll try to pay it off every month. So depending on when it hits. So if it's $60,000, you better believe the score is going to be a lot lower than if the next month the report's at 10. Nothing to do with the inquiry. The inquiry with this jump, this is going back and forth 20, 30, 40 points all the time, and an inquiry may add 1 point.
Do you think that you can give us the fact sheet? Not today.
On credit? Sure.
No, I already have it written down. We'll give you like a specs thing.
Yeah. Just in general, sure. Just a lot of these.
Yeah, a lot of the tips, absolutely.
If we have that and we could save it as a document, we could actually, I'd slide that right across with the CIS, right at our initial.
No, it's good.
Just really good.
And once again, not just for your clients, your kids, your grandkids, your friends, your family. I've helped out a lot of my friends. I've had meetings with family friends having nothing to do with mortgages. They just want to sit down and talk to me about how to fix their credit.
But in the world of real estate, I did have, two different situations. Once I had a family that was buying a house. We were under contract right before we were closing. The wife decided to accept a new job for more money, but the lender would not. They said, "We'll still give you still, approved. We're still going to give it to you, but now you have to be at that new position for 6 months. We want to make
6 months.
Yep, we want to make sure that you can be at that position for 6 months. Maybe it was a bank with a green sign. I don't know. I don't know. It could be. I don't remember. This was about 10 years ago, but they had to wait 6 months. And actually, every story I have is interesting. I have to honestly say, there's always drama. Real estate. I don't know why. Real estate. We should all be writing books, but just from the experiences. But they told her she had to wait 6 months, and I represented the seller. So she had a buyer's agent who clearly didn't say, maybe there was a conversation and she must have said, I'm so excited. I'm going to be getting a new job and making more money. Isn't this going to be great? And the buyer's agent should have said, no, it's not going to be great. Wait until after you close and then you want to switch jobs and get more. But she was a teacher becoming a professor. I don't know, something.
She was a teacher and they made her wait 6 months.
She was still within the same building. It's not like she left teaching and she went into engineering, and the mortgage broker said, oh, we really need to know if you're gonna stay in that.
Yeah, that was
6
totally
months.
wrong.
She was in the same
If you called me, she would have.
Well, I don't know where you were 10 years ago, but
Yeah, I was.
clearly we're on the right path now, clearly. But what I'm saying is, she must have had some conversations with her buyer's agent, who did not say ixnay on not changing the
Yes.
job, put that off. And then I had so what happened with that was the seller still wanted to sell and the buyer obviously still wanted to buy, but now it's not like they were saying, hey, I'm not going to buy your house tomorrow. The lender was saying, we're not going to let you buy the house tomorrow. So I was trying to explain this to my seller, who had a blockhead or head, but I
mean,
said,
I get
you
it.
know, they still want to. I said, so why don't you, I think somehow we were going to work out a down payment so that he could still move on to his next, and we were all into contract. He could still move on to his next purchase, and he was going to rent. It's going to be a contract, not like, hey, you just give me $3,000 a month for 6 months, and it's all in writing with our, real estate attorney, that these people could, because they were leaving where they were going. It's a mess, right? It's always a lot of moving parts.
Mhm.
One thing is contingent upon the next. So we're trying to make it work, which is what we are as Houdini, just try and make it work. And so the buyers wanted to move in, rent for 6 months, and then at the end of 6 months, the mortgage company said, okay, then we'll have the closing then. And this seller could not wrap his head around, I just wanted to sell to somebody and have it clean.
You're lucky you held that together.
We all did. No, he chose, he backed out.
Oh, you backed out.
He actually backed out.
So had you called me, just so you know, if you ever have that issue, give me a call, because I would have solved that problem.
So I lost that commission.
Yeah. No, well, listen, I can help someone with an offer, and I did. I mean, last November, I closed on a deal where the person wasn't going to be even working for the company. He was moving from Jersey to Florida. Okay. His job
Completely
didn't start
different
until
company.
after he moved there. Completely different everything. Yeah, it was a moving company. But I had an offer letter that was dated, signed by the employer with a start date and his base pay on the employer
And
letter.
you were okay with that.
Yeah, it's in the guidelines, sure. Yeah, that's no problem.
Another reason.
Yeah, so if it's a
Why we
teacher, it's a
need-
salary. So basically every teacher has a salary and a contract.
Yeah.
So if I had so you would have an offer letter. So if I had an offer letter showing the new job, there's some guidelines
That's
to it, but yeah, no, 100%. Yeah, no, that you shouldn't have lost that.
Yeah,
Actually,
thank you.
and not to go too off on a tangent, then we'll get back to the credit, but I
But
build my
these-
business.
This is how it affects
Oh, it's 100%.
our world
I-
is, or people at the 11th
Yeah.
hour buying a car a week before they're closing.
Oh, we
Did-
had
I've
that.
seen that.
We had someone
I-
sign on
I
a
certainly
house
had that.
before Christmas.
Lose the deal. And I'm like, X-nay on the furniture, the car, we don't care what
You know
you
what?
do after
No matter what you
January
do
2nd,
correctly,
is that your closing? January,
Yeah.
go out on the 3rd for a shopping spree, I don't care, but
no matter what you do
people
correctly,
just
you
don't
can
know
solve it.
this. They don't know this, and I think,
Yeah, I mean,
and it's not the seller that's running out buying the
It's good
car,
for the
it
realtor
is
to
the
help out too.
buyer's agent.
Yeah.
That needs to say, by the way, like, I don't even know if you're thinking about buying anything, but don't buy anything until,
yeah, we have it at my
I
last
closed it.
2 companies. We've had it, like, we have these automated emails that go out in the middle of the transaction that literally say, don't do anything.
Yeah.
Just gives them a bunch of do not do
Yeah.
thises. But
We
no,
need that.
as the
We
agent,
need that.
it's really good because, I have been, if you're busy enough, I mean, no matter what you
so
do, you
actually,
can
to
run
that
into
point,
things.
if the agent doesn't remind the client, you are sending out something that the client is getting
Well, I mean,
directly anyway. Like, don't do
I'll be
this,
honest.
don't do
I
that.
don't really have this issue often because I'm big on communication. A lot of lenders are not. A lot of lenders. So you have to understand that when you are buying a house, it's a 3-step process, right? It's not like realtors. Like you have your brokers and your team of them, but it's a little different because you're more of a one-person show in the real estate transaction. Lenders are not like that. So you have a loan officer who is effectively a salesperson, right? Then when you go under contract, a lot of them will hand it right up to a processor. That's a second job. It's a processor. So that's why you may hear, and you probably had some frustrations with the processor, but they're the main communicators with the attorney and everyone. And a lot of times they'll know more than the loan officer.
And then it goes to underwriting.
And they're sending it to the underwriter directly.
So those are 3 separate people.
Yeah, that's why you could have a loan officer that's closing their first deal that really knows nothing, and it can actually close because there's the processor there that is, in some cases, killing the deal immediately once it goes in. If you get that, because I've taken these over.
Kill the deal.
Yeah, no, I've gotten deals where someone's
Real
pre-approved
estate
looking for a house for months, and in the moment they get their offer accepted, they have to tell the client, actually, this was all wrong. We can't do this, and they'll call me.
Yeah.
So I built my business by putting together denied deals because I was trained to underwrite loans a little over 15 years ago. When you know how to underwrite, so I basically know how to do the loan officer job, which is basically selling applications, things like that, walking people through the process. But I also know how to do the processing, and I also know how to do the underwriting. So if you know how to do the underwriting, the beginning part's super easy. You know everything that you're going to need. You know all the rules, stay on top, and that's how you can take the ideas and put it back together.
The process for each one of those.
I mean, it's hard to say standard because there's so many moving parts. Yeah, I mean, yes, there's your basics, right?
Process,
but it can definitely get more complicated from there, right? Because every situation calls for something else. It's why so many things can go wrong, right? So many things can go wrong.
And real estate too.
Yeah. Well,
So
when you lose a deal,
wrong.
how do you lose it? It could be something on title. It could be something with the appraisal, with the house, the water. With the inspection, the well was built 74 feet away from the septic tank, which is unacceptable, right? There's so many. I was once trying to do an FHA loan here in Rutherford. It was right here, actually. It was right on Park Ave, but there was a gas station across the street, and unfortunately, a lot of appraisers would let it go, but this appraiser did not, and it's actually the oil tanks for the gas station were too close to the house. So it was an issue to the well. So, there's so many things that could go wrong. An underwriter is not a salesperson. They don't talk to the clients. They don't talk to you. They are the logic, reasoning, and know all the data people. And that's why they're not really communicating with anyone. The loan officer is a salesperson. And here's the thing, with a lot of jobs, you don't have to know anything. If you are charming, charismatic, you can get really far in terms of getting clients. The problem is that once you get that client, it has to go to an underwriter who, this has to work out. And that's where a lot of deals die, either through an underwriting or once the processor sees it. And that's where I come in and I put them back together.
But there has to be a way for the loan officer to really know which ones will come to fruition. I mean,
the problem is you don't know what you don't know. So the reality is, if you're not trained to underwrite, which almost no one, very, very few people, almost nobody is, right? I've maybe met like a couple people through networking that also are going down that path, but for the most part, it's hard.
Asking this of
You definitely should. Actually, I've coached realtors to always question their lender. I'll tell you this: if I put in a pre-approval, if I'm part of an offer and the listing agent calls, I welcome that call. And I always say, I am so glad you called to verify that I'm not an idiot, that I know what I'm doing, that you can trust this offer. I welcome that call. I welcome the opportunity to tell this person we are solid, that we are going to close quickly. I will go into who I am, what I do, the borrower, how strong this is, how quickly we can close. I let them know that I'll be super communicative. If you had that call with me on my first week of doing this job 17 years ago, it would have been a completely different conversation, right?
So you've been through all of your
yeah, I've been there and done that. So, but in the beginning, I mean, sure, it was much more difficult when I first started. So you got to feel the balance. Look, the reality is this: it may even be hard to even do that. It's the modicum that you can do, because the reality is, look, if you guys go to a mechanic to get something changed, okay, whether it's your oil or your alternator or whatever. How do you know if they did a good job or not? They could have put everything on backwards, and then now it's just a weird noise you hear in 6 months from now, right? You have no clue. You just assume, oh, they're a mechanic,
And they're good.
That should, yeah, that
And
should
they're
work. But think about any job you've ever had in your life. Has everyone known what they're doing in
But we
every
don't
single
always,
job you've
as
ever had?
consumers, know what, I wouldn't know what questions to ask an
So
accountant.
as a realtor, you really, I mean, look, it's like I said, it's the least you can do,
Did you
but
do your homework?
you just try to look, if you ask me questions, understand you will get nothing but absolute certainty and confidence. in
This
what
is
I
why
say.
we have you.
Absolutely. That's a
without-
good start.
So without saying any names, where you did your last open house with me, without saying any addresses, an offer was submitted for over asking, and 90% of the conventional loan was 90%. 10% down, they split. This is interesting. The offer was 1.6. They put down, the buyers on the offer, $30,000 initially. My sellers said at 1.6, they're only putting down 30,000. That doesn't look good. That doesn't look good to me. And I said, well, look at the back end. I think they were putting down 135 or 145, right? So it made up. And they said, yeah, no. This is what my seller said. They don't have enough money to buy my house. And I said, well, they were pre-approved, and the mortgage lender called me, said, hey, I just want to intercept any skepticism. I know this looks whatever. They just moved from California to here. He's an attorney. He started a new job. I've seen his offer letter, et cetera, et cetera, et cetera. They got out of a house. They actually didn't make anything, so they're kind of starting over. But I can assure you, we can get this mortgage commitment within 20 days, he told me. I was like, okay, but that's, okay. He said, no, we're going to do it. We're on it. We know who wants it. We know the family, whatever. We know the mom, we know the brothers, the sons, we know everyone. And if he can't, money is going to come in from somewhere. We've got this. And my people wouldn't accept it because it didn't look strong. So I said to the buyer's agent, can you switch around those monies? Can you put down 140 initially? That might make my seller feel like he's a little more in it, and bring 30 to the closing. It was still the same cash to, and it didn't, the seller would not accept it. And then he just kept saying, 90% financing. He can't afford my house. And he dismissed it. Dismissed the offer.
That's unfortunate. Yeah. If they like the offer. I mean, there's no.
What not to do. Okay. I can run a whole seminar on on transactions that haven't closed. Why they haven't closed. The knuckleheads I deal with. Because I said to the sellers, I spoke to the lender, right? I received, assurance, and
at the end of the day, it's unfortunate because it's a big misunderstanding of, I mean, listen, even if it's 0% down, the reality is, it really doesn't matter what they put on the deposit. I'm sure there's some protections there, but this is New Jersey. If they get denied, they're getting the deposit back.
So another thing about this house and these sellers, no names mentioned, sounds like we received several offers prior to this one. And for the portion, because it was such a large purchase, for the portion of the down payment and what they're bringing to the table at closing is, $150,000 or, $250,000. I not only asked for the pre-approval, but I said, I need your proof of funds because I need to know where $250,000 cash is coming from. And they would show, and rightfully so, $250,000 if that's what they needed. $250,000 in this account, it would say like 260 or 270. And my seller at one point said, look, that's all they have. And I said to him, they're only going to show you what they need to cover for this offer. They're not going to show you that they have $400,000 cash, because the first thing you're going to say is, oh, you have more money? Well, then you should have offered more. I'm going to counter you for another 100,000 or another 50,000. And they don't want that. So, you know, there's a lot, you know, so I said, think about that. Are you going to show all of the money you have to make this? No, you don't want the seller to know that. You're obligated to show me a proof of funds for exactly what I need on this offer. And he just could not, the husband could not wrap his head around. But that's all the money they have. I said, you don't know that. Yeah. You don't know that. I don't know that. And let's just say that's all the money he has. If he's pre-approved and he wants to spend every penny to buy this house, and everyone is saying he can do it, and he's going to be cash poor afterwards, what do you care?
Yeah, so it's also very, you know, I guess I do work with sellers when they're buying and selling, but
I was gonna say something emotional.
yeah,
We need a psychology class.
you know what? I'll tell you.
That's going to be next.
Here's a recommendation, because I do this when my client is doing a simultaneous sale and purchase at the same time. They will ask me for advice, and I've had this call many times. Hey, I know it's not, you know, it's not your transaction, but you know, we have.
So I've had sellers to say, hey, I'll accept this, but I want my guy Norberto to look over the loan or to make sure that the pre-approval is okay.
Yeah, you know, you could do that. I mean, I always feel weird about that, to be honest, because it's always, if a lender's working with someone for a long time, you know, like to have another lender, some of them try to do it just to give like business to their lender friends. So sometimes like they could be very apprehensive to that.
But could a seller say that? Because they did have that happen once.
They have the right to do that.
Yeah.
100%. But like you can't, it's illegal to make someone use a specific lender.
But you could have them.
But you can definitely say, I need to review. That's not a problem. Okay. But I'll tell you this. I've had clients who are selling their houses and they're buying at the same time reach out to me for advice on this offer that came in. Is it realistic? Is it? And, you know, sometimes I'll say it's not, but for the most part, I say, yeah, it's completely fine. Because look, at the end of the day, it doesn't matter what the down payment is or what the, look, is this lender able to close this loan? All right. You know, I've helped people buy houses 0% down, full seller's concession, putting $0 into the transaction, and we close. Why? Because I know what I'm doing. As long as the lender knows what they're doing, it doesn't matter if it's 5% down. I mean, honestly, before everything got crazy in 2020, I used to tell my clients all the time they wanted to put 20, 30% down. Why? Put 5% down. Right. We'll buy a primary. Then next year we'll do it again. Next year we'll do it again. We'll pick up 3 or 4 primaries with a lower rate, lower fees. You know, that's, it's called house hacking now. But but now everyone's like, oh, I need a bigger down payment because it's. Okay, does the lender know what they're doing or not? If the lender knows what they're doing, they're going to close, regardless of that.
But our job as a buyer's agent is to get our client's offer accepted. And if Mary over here is submitting an offer for this house and she's only putting down 5%, but my client, right, this is, you know, exact situation as what I just had. My client now is putting down 20 or 30%. The seller looks at this and says, oh, this is more money down.
Yeah.
So our job is to get that client's offer accepted. Once we're under contract with them, can't we say, you know, we would like to go back to 5%?
That's actually a great question. So here's the thing. There are people that do that deceptively when they don't have 20%. They'll say they have 20% and they'll switch it later. Some even will switch from, you know, conventional pre-approval to an FHA loan.
But even if you do have the 20%,
if you
show it up front, I have 20%, and then you can change your mind and say.
It's super easy. So look, the reality is, unless the lender has an overlay, I change down payments all the time. If some, like, I mean, look, because I'll tell them, look, I have someone right now who just put in an offer. I think it's silly. He's putting $200,000 down on a $460,000 house. I think that's crazy. There's so many better things you could do with that money. Usually when I tell my clients about that and I kind of run through the numbers, it just makes sense. I'm not trying to make my loan higher. It's just not a great financial decision in my opinion. So I just give my insight on it. But I'll tell you this.
Yeah.
I said, look, it really doesn't matter. We're going to pre-approve it now. If you want to revisit this, we'll revisit this, you know, while he thinks about it. So we put in the pre-approval for 200,000. And like I said, when I need to change as long as I'm not changing the purchase price or the loan product, right, the conventional loans, FHA, then I don't need to get an amendment or anything on the contract. Some lenders may have an overlay where they want an amendment to the contract stating that the loan amount or down payment has changed. I mean, it's not in the guidelines, so I actually don't require it. So if I want to change a down payment, I could do that at any time. Usually, if we're going to, so let's say someone has 20% and they're deciding 10, 20, 30% down, I'll say, you know what, let's do it as the contract says, let's do it at the 20%, we'll get our approval there. That way, when the seller sees the approval, they're not like, what's going on? You know, not that it would matter because look, if we get an approval, we get an approval. Who cares at that point, right? That's all you wanted was to close. But I usually will change the loan amount after we get the approval. Okay. But yeah, you can change the loan amount. There's nothing wrong with that.
Let's talk about the scenario where it's a $460,000 house. You have a client that wants to put down $200,000, and let's say, you know, you get to closing and whatever, you change it to lower. Now he's only putting down, I don't know, 40,000. Sure. Could he or could he not take that $160,000 that he didn't put down and put it once the mortgage payments start? This is something I've heard that I need some clarification on. If you take that money after you get your mortgage, and you put it into just the principal, does it drastically reduce
the
length of the loan, the amount?
It'll definitely, yes, 100% it'll
as
definitely
opposed to putting down the 200 up front.
So it's a very good question. So a couple things. It will be different if you do it that way because it's not like a credit card. Think about if you've ever had a car loan before. Was your payment the same from the beginning to the end, regardless of what the balance was? Usually that's how it works. That's how mortgages work, okay? When if you have a fixed regular, let's say 30-year fixed loan, okay, let's say, all right, so let's just say it's a
monthly payment is $2,000.
Sure. So let's say your payment is $2,000. A portion of that is principal, a portion of that is interest. Regardless of how it worked out, let's just say anyone right now who has a mortgage, you look at your mortgage statement, your payment will not change if it's a 30-year fix, let's say, but the principal and interest portion will change.
The portions are changing.
Now, that interest is not a random number. What happens is every single month, what the mortgage company is doing is they're saying, how much do you owe on your balance right now? Today. Let's say your interest rate is 6%. Let's say it's $200,000. Well, what they're going to do is they're going to say, okay, 200,000 times 6%, okay? Then when you have that number, you're going to divide by 12 for 12 months. That is the number that will be the interest on your mortgage statement that month. So if one day it's 200,000 and then you get a bonus, you get $100,000. Now you pay $100,000 towards the principal. The next month, what's going to happen? It's going to say, great, $100,000 times 6% divided by 12 will be your interest. The payment will still be $2,000, but now the interest just got crushed in half. The principal is a lot higher, and the amount of years left goes down. Now there is something called recasting.
But is it better to pay the $200,000 upfront as the down payment, or to wait until you get the mortgage payments and then put $200,000 down?
I would definitely say,
scenario,
if with no other variables, if you're just deciding whether or not to put a larger down payment at the closing
versus more
or less, and then putting it in a month later,
yes,
there's zero reason to do the latter because you're going to have a higher down payment, which is more attractive to sellers. Listen, although I do believe the down payment thing is silly, if the lenders, if they're good, they're good. But the reality, that's not how life works. The sellers want a bigger down payment. We show them the bigger down payment if we have it. Number two, your payments will in fact be lower, and there's no benefit on the interest side.
So which is better?
To do it up front. It's better
Do it
for
up
the
front.
deal because you're putting in a bigger down payment, makes it easier to qualify because your payments are going to be lower, and the payments on the mortgage statement will be lower on day one. Okay, and there's zero benefit in terms of the amount of interest you pay, because remember how it actually works. Every single month when you get a mortgage statement, if you want to do the math, you take the balance times the interest rate divided by 12. That will be your interest that month. So whether on your next month the balance is 100,000 because that's where it started when you closed, or because you get it down to that, the interest portion will be exactly the same. The difference is if you do it up front and it's a lower loan to start, your payment will be lower.
But the benefit to putting some money down after is to shorten the 30 years.
You could. I mean, that's not something that I advise. Like, I don't prepay. Like, I'm not a big fan of prepaying. I just think there's better things you can do with the money. If you think about it,
That could
okay,
be a whole other class.
that's a whole nother class. But there's better things to do with the money. Like, honestly, as a realtor, anyone in this room, you have an extra 10,000, you're going to put that into your mortgage. Here's a better idea: put it into your business. Okay, and you will make a lot more money than, I mean, you're talking about a tax deductible interest. Okay, it's tax deductible, so you get a portion of that back. Okay, and then honestly, listen, I don't know what everyone's brokerage accounts are making right now, but many of them earn more than the interest rate on the mortgage. Listen, when the rates were in the 2s and 3s, I took out so much equity from people. You know what they did with it? Hey, I got a ton of equity, but I want to pull out 200,000. Why? Because I want to put it in the market, because I'm going to have a 2.25% interest rate, tax deductible. So I'm really paying like 1.8, right? And then at the end of the day, now I'm putting that into my brokerage account that's making me 12%. So every month I'm losing 2.25, but I'm gaining 12. There are so many better things you can do with the money than prepay a mortgage. Personally, I'm not a believer of that at all.
Okay.
I have a question.
Sure.
Okay, like, let's say for example, you're planning to buy like a second property. Is it supposed to be the down payment?
10.
Is it just 10?
Yeah, you can only have a single family second home, so there's only one possible down payment is 10%. If it was an investment, single family is 15, 2 families 20, and then 3 to 4 unit is 25%.
So has that changed? Because
They
I've heard
changed.
before that it was supposed to be 20%.
Overlay. That was probably, yeah, the lender had an overlay.
So
It's
that
been
Now
10%.
it's just 10%.
It's been 10% for a long.
I didn't know that.
It's
But
probably
what
the
if
lender
you-
has an overlay.
What if you own those houses? You own 2 houses.
You mean like a refinance?
And you own 2 houses and you want to buy a third.
Okay.
Do you still need to put 10%
Oh,
down?
great question. Okay, so you know what?
I have a lot of great questions.
no. Well,
Carol says I
you know,
have a lot of great
it's
questions.
an interesting question. So
And it's,
in the mortgage world, it's actually a semantics thing. In the mortgage world, we have 3 buckets for what this house can be. It's either a primary residence, a second home, I should call it, and then an investment property. So we all know what a primary residence is, very clear what an investment property is. Second home is, it's a vacation home, right? Think of it as, when you hear the term second home, don't think the second house that I own. Think vacation. That's what it means. You can have 10 second homes. It's just the third option between primary, investment, and second. It means vacation is second. So you could have.
you could do whatever you want for the
Yeah,
third.
if I want to have not a rental, but just a house that I can go to anytime I want for vacation, if I want a vacation home in Florida and in California and in Colorado, those would be 3 different second homes. All of them I can purchase for 10% down.
As a realtor, I guess when you're working with your client and your client says, hey, I own 2 houses, but I want to buy another one, right? They don't.
So that's 10%.
10%. Yeah, and it would have to be a single family, right? They don't consider a 2-unit a second home because one of those units has to be a rental, right? That would be
You
crazy.
can't
if
live
not.
on both sides.
So a 2-unit is always an investment. That's where it could go. That would be the only thing. If you were, if it was a 2-unit, then perhaps it was 20% down. Okay. Actually, I have to double check. You know, they changed it. It may even be 25 now. I can double check. But they don't do as many investment multi-units.
And this is if you have mortgages on the first.
It's irrelevant when you are,
Okay.
if you're getting a vacation home, you could be living in your parents' house, not own any houses, but you can get a vacation home for 10% down.
But you can't do less.
You cannot do this.
Okay.
Okay.
Good to know.
Yeah. So just remember, with a conventional loan, it's 3% down for a single-family house or a condo, if everyone is a first-time home buyer, or if there is a first-time home buyer, rather than change it. If they own a home already and now they're going to buy another house, or if they've owned a home in the last 3 years, which means they're not a first-time home buyer anymore, if they've owned a house in the last 3 years, then it's 5% down for a single family if they're not a first-time home buyer. Okay. Actually, it could also become 5% to 1 to 4 unit with conventional if it's a primary. They changed that last year, so now it's 5% down for a 1 to 4 unit primary residence, 10% down for a second home, and then investments, single family is 15% down, and then 3 to 4 units or 2 to 4 units are between 20 and 25% down. I just need clarity on the 2-unit investment. I believe that's 20, could be 25 now. When you're doing as long as I have, it's like, you know, you memorize everything and they change it and they're constantly changing it. So between 20 or 25% for an investment.
Do you do refinance also?
Oh, of course, 100%.
So this is where you need to get your buyer to reverse.
Yeah. We'll take care of it.
And they will say, you know, they're pre-approved for, what they should put down, what they need to put down, what they have to put down.
Yeah, you know, and I appreciate that. I mean, the reality is there's 2 things that are important. The lender themselves and the loan officer. I remember I once heard a realtor say they had a pre-approval from a client that she was trying to send my way, and there was a pre-approval from Valley, and they said, you know, the client was not happy. I know only go into bank things. They weren't happy with the other bank. And sorry, and they wanted to come to me, and the realtor was like, yeah, you know, because I met her networking so many years ago. I don't remember who it was supposed to be honest. I just remember the conversation.
She wasn't us.
No, this is honestly I can't even remember her name or face, but I just remember the conversation itself. And I remember her saying, yeah, well, they're already pre-approved, but you know, who cares? Like, you know, all the banks are the same. And I remember her actually saying that to me, and I was like, what are you? And that's why I always like to say, and you've probably heard me say this before, if you've heard me talk before, and you'll hear me say it again. I love saying those words. Think about any job you've ever had in your life, because anytime I say this, something rings true for everybody. If you have 20 employees at any company, the chances of all 20 of them being very good at what they do is like non-existent. There's a Pareto distribution through every job. Of course. If you think about any real estate office, how many of them are great? Really a very small percentage.
We just,
right?
on a side note, we just had a realtor that was trying to sign paperwork for a lease. He or she was going away on a vacation for a month, and they just wanted to wrap up the paperwork before they leave. So they thought that they could sign on behalf of either the tenant or the landlord just to get it done. And we've built a relationship and we trust each other. So I'm just going to sign for them because I'm going away tomorrow. And I can't wait next week for Jack to give us their personal signature. Which I heard is okay. You need to go away.
Yeah.
And talk to you when you come back. We're absolutely not signing for anybody.
And what were they saying?
They wanted to. No. They didn't even. Okay, they could have sent it out DocuSign. They just didn't have enough time before their vacation, so they said, you know what? I'll sign that lease for you, or I'll sign the paperwork. And the second, let's just even say they're signing the lease on behalf of the prospective tenant. And the tenant moves in and he just decides he's not going to put, I know you had a good relationship with the landlord, right? Don't worry, I'll sign this and we'll get somebody in here who starts paying. And they get in and they don't pay. Who signed that lease? That tenant says, I never signed that. So when it comes to money, you know, you could say you have a good relationship with someone. Let the landlord sign for the landlord. Let the tenants, you know, and you think that these are conversations you don't have to have, but apparently you do. So,
you know, it used to be a big, so everything we do is e-sign now, but I remember, you know, when I started e-signature, we used to hand sign all the apps back in my day. And I'll tell you.
But you didn't sign for anyone.
Yeah, you can't afford a signature for anybody.
But you know what, even going into that, a lot of times a spouse would sign for a spouse. And the underwriters sometimes would be like, whoa, these are two different signatures. And I mean, obviously not at the closing, but you know, so it's less of a thing for me now because almost everything I do is e-signatures. But as you could imagine, back in 08, 09, 2010, you know, I don't even know. Yeah, e-signing wasn't as much of a thing. We would email things to people. They would print it, sign it, send it back. And every once in a while, the underwriter would be like, this is not the husband's signature is terrible. Like, what is this? You know, this is a beautiful signature. And so they would get picked up, different inks, you know, we would see. Yeah, you know, it's so funny you're bringing it up. It used to be a thing, but I don't really run into it anymore just because of e-signing. You know, everything's e-signature.
Well, we just ran into that.
No, yeah, you should never. And actually, that's exactly the reason too. And I remember I learned that really young. It was with my very first employer because I had a client. You know, I was brand new, so I was kind of getting pushed around a little bit, as some may. The client was actually a realtor, so you know,
I appreciate you saying realtor.
Yeah.
I want to thank you every time we have a class.
Why is that?
Well, you know, there are other people that say,
realtor?
I should have a board up here. It is not 3 syllables.
Realtor, yeah. Yeah, no, I've always said realtor.
That's step number 1. I should start out this class. It's real. Everybody say it with me. Everybody say it with me.
But yeah, no, I remember I was getting pushed around. She was saying, she asked, because, you know, I was like, hey, like, I need you to print this out and sign it to the back, like, you know, because everything's always on time. Oh, I'm too busy right now. Can you just print it and sign for me? And I was new, so I went to my boss at the time, and I was like, should I do this? And he was like, and he gave me a lesson. He's like, absolutely never sign for anyone. It's great if it's fine, but like, what if anything goes wrong? You committed.
It's crazy because even the person that Anne's referencing used to work at a bank.
Yeah,
I mentioned that's something that they used to do.
No, listen, I don't play around with
their own, but
yeah, you know, it's just not worth it. It's just not worth it.
Well, they kept saying, you know, I built relationships and people trust me, and I was like,
that has nothing to do with it.
That doesn't even
because things are okay until they're not.
Everything is okay until it's not.
Yeah.
There you go.
Yeah, every time you see two friends in court, you know, how'd they get there, right? Something.
Yeah.
So
No, business fences make good neighbors, and business is business.
So, and you know what? I'll tell you what. Just because we've been, and this is great. I feel like we covered a lot. Let me just finish off on this slide because just to complete that part, and then we can put this down.
I do have a question too that goes into credit.
No, go ahead.
But I have a friend that wants to buy a house eventually. She has no credit. She has a good credit score based on like whatever, I guess, Credit Karma or Experian gave her. But she doesn't have a credit card.
Okay.
So she's like worried that that's going to affect.
So how does she have credit?
Yeah, how does she have credit?
Because she like, I guess her bills and whatever, like she has a leased car, like she rents.
Okay, so she has a car. Okay, so she doesn't have credit cards.
Yeah.
Okay, so I'll give you some advice on this, and you want to do them as early as possible. So
the advice he's going to give is just his phone number. Have her.
Well, I can definitely help. Yeah, I can definitely help.
This is a lot.
Yeah.
But she wants to open, if she's got a credit card, she wants to get started on that immediately. Okay, why? Because 15% of your score has to do with the length, the average length of your credit history. Okay, so what do I mean? If you have just 3 items on your credit report, okay, you have 1 credit card that's 2 years old, 1 auto loan that's 4 years old, and then I don't know, another credit card that's 6 years old. So 2, 4, and 6, the average lifetime is 4 years, right? That factors into 15% of your credit score. So for those who have an old $500 credit card from the college years that close them out, never do that.
Don't close them out?
Do not close them out. Keep all, unless it's like a secured credit card that has an annual fee or something like that. Do not close out old credit cards. In fact, you want to make sure you're using them. So I told you I have like a dozen credit cards. I rotate them. Okay, I have like a little box where I put them, and I switch them out. So my wallet is literally just this guy here on my phone. You rotate them. Just buy it. You don't have to buy anything big, or you don't need a TV.
Or just
You buy
whatever
a sandwich, you get a tank of
purchase is
gas. Yeah, you just use it every few months, and that'll keep the account open. Because if you have an account that's 20 years old, that's a lot better than an account that's a month old. So a lot of people don't realize that if you open up an account, a credit card, a car loan, or a mortgage loan, for at least 4 months, your score is going to take a dip. Not just that, but then you've lowered your average length of time that you have with all your credit cards. Now, if you have a bunch of older ones that are 20 years old, one new one is not going to affect you as much. But if all of your stuff is relatively recent, then it will have an effect. It's about 50% of your score factored into the average length of time. So she wants to open up cards as soon as possible.
We conversation because she was telling me that she's struggling opening cards.
Great.
That's
Okay,
actually
so I'll
why
tell you how to
she
do that.
gets, like, denied.
Super
She's
easy.
Like, how do I even start?
If you have someone in that situation, you should write down Chime, CHIME, a Chime card. It's a type of secret credit
I've
card
heard of
that's
Chime.
really good. Well, number one, you need secured credit cards. Chime has a very specific feature that's really interesting. Okay, so here's how anybody can get a credit card. It's super easy. There may be some annual fees or whatever it may be, but anyone can get a credit card, of course, because they're called secured credit cards. They're collateralized by a deposit. So what does that mean? That means if I want to apply for a $500 credit card, that's fine. I just need $500 to start in cash, okay? Because what will happen is, let's say I apply for a secured credit card. You want to get one that reports to all 3 credit bureaus. A lot of them will have fees, okay? I don't think they should necessarily have fees because they're already going to have a super high interest rate. And they have a deposit, which eliminates any of their, risk for the most part. They don't allow you to go over that deposit. So, but if you want a $500 credit card, you need to give a $500 deposit. Then you're starting with a 0 balance in your credit card, so now you can use it. Go spend $100, spend $200. They're giving it to you no matter what because you just gave them $500. If you don't pay them back, they're going to take your $500, right?
Like a debit card.
What about store credit?
Well, no, it's
Yeah, like,
so I'll answer both questions. So it's not like a debit card. It's because it is a credit card. The difference is they have a deposit, so you can apply
when do
for
you
it.
get that
Debit
deposit
cards
back?
don't report to credit. You'd have to see the terms. If they give it back to you, if you close it out, maybe, or they may keep it. I actually don't even know what happens after, but I will tell you that you can certainly get them. No question about it. And if they had to keep it, then I'm sure they would give it back. But even if they had to keep it, to get you a credit card, look, it doesn't have to be $500. It can be $200. But the important thing is it reports. So it's not, a debit card does not report to the 3 credit bureaus.
Right.
Meaning, you want these accounts on your credit report. Why? Because what is the credit report doing? It's telling lenders like me, hey, I've been watching them. When they borrow money, they pay it back. Every time you swipe your credit card, you're borrowing money. A debit card is not borrowing money. A debit card is saying, I have $1,000 in my bank account. I'm going to take $200 of that and give it to them digitally. A credit card swiping $200 is saying, I don't have to have any money in my bank account. I'm going to borrow $200 from Visa and I'll get them back later. I guess I'm good for it, right? And that will be reported to the credit bureau saying, hey, this person just borrowed $20 or $200 or whatever it is. We'll see if they pay it back. We'll let you know next month, right? So that is what's going on. So a credit card is different than a debit card. And still, even worse, you have to pay this thing every month. If you miss the payment on the secured credit card, it's going to hurt your credit, right? So it's going to have the opposite effect. So You want a secured credit card reporting to all 3 credit bureaus. And I'm sorry, what was your question?
What about store credit cards?
Great
Every time you
question.
buy something,
Yeah,
Right,
so
they ask if you
Yeah, I
want
must
to,
have-
like
I
Home
must have
Depot.
20.
yeah, so I mean, so I'll tell you about those.
Marshall's, TJ Maxx.
There's
I'm like, I should've
nothing.
known something.
I'll tell you this. There's nothing wrong with store credit cards at all. I would keep them open, and I'll tell you why. Number one, you do get benefits. Usually you have a significant discount of some kind when you use a store credit card. Now, a lot of people will balk at the fact that almost every store credit card has between a 27 and 29.99% interest rate. That's not a problem. You don't have to pay interest on any of your credit cards. Did everyone know that?
You don't. As
You
long as
do not have
it
to
off
pay
now.
interest on any credit cards.
Pay it off at the end of the month.
Okay.
Go on.
Well, and not
But
even the whole
don't-
thing.
but
You pay the
don't-
statement balance.
Right.
Okay. So every single month, for anyone who's at a credit card, when you go to pay, there are 4 options, right? You have the statement balance, the outstanding balance. This could have different terminologies, but your outstanding balance, your minimum payment you could pay, or
Right.
choose your own payment as long as it's the minimum payment. Those are your 4 choices. Now, the statement balance and the available balance are usually different, and the available balance, or rather the outstanding balance, is usually more than the statement balance. Does anyone know why? Anyone have any idea?
Cumulative. The outstanding balance is all of it, isn't it?
Well, yes, but the important thing is it's outside of the cycle, right? So let's just say today is what, the 16th, right? Okay, let's say I opened up a credit card and the statement cycle, it's a monthly cycle, right? And the bill comes, is from the 1st to the end of every month. So my last cycle was from June 1st to June 30th, right? I think it's 30 days in June. I never did this.
Yeah.
We're all singing it now.
So,
It's a limit.
yeah. So let's imagine I opened a credit card June 1st. Now my cycle started. It goes till June 30th. I get the bill sometime after June 30th saying this is what you do. Okay. Between on June 1st, I had a 0 balance. On June 15th, I went to dinner. I spent $200. Now and that's the last time I used the card. Come July, let's say June 30th, my cycle ends. I've still only spent $200. My bill hasn't come yet. Okay. A day or so later, I spent $50. Okay. Then I get my bill. The bill says the statement balance is $200. My outstanding balance is $250. The reason why is because the cycle ended in June. I had spent that additional money after that happened. In order to avoid an interest payment, I only need to pay everything that I borrowed in the last cycle, which is your statement balance. So I do not have to pay $250.
But you have to pay the
I have to pay the $200. If I only pay $150, then $50 will get tacked on to the new one, and that it is carried over. So I'm going to pay per diem interest on that balance. The new $50, that is not an interest event yet. That doesn't happen until later.
after the next
But the initial $50 will start charging me interest per diem if I don't pay it.
So what credit cards did your friend try and get?
She told me that I don't know that.
Well, I'll tell you why
She used,
Chime
like,
is
the
good.
app, and it gives you like what you're most likely to get approved by, like whichever card. She said she applied that one.
If she well, listen, she should probably try to get approved by. Let me give you guys some tips of advice. So I'll tell you, let me close this out. I'm going to give you some advice on how to bring your credit score up. So once again, guys, 35% is lates. I guess we don't have to talk about that. You know what? I'll tell you one thing about lates, just so everyone knows. A late is 30 days late. Okay?
Not just right after the cycle.
Right. I hear all the time, I'll hear, not that I even care, I've seen thousands of credit reports, but people always like to tell me why their score is low when there's issues with it.
It's why
And-
they think they're scoring.
Yeah, well, a lot of times they'll tell me like, oh, they gave me these 2 lates, I was only 3 days late. I don't understand. And
It's 30.
it wasn't 3 days late. It was maybe 33 days late, because if your bill is due on the 1st, let's say a mortgage payments, mortgages are always due on the 1st. You have a 15-day grace period on a mortgage. If you pay on the 16th, that's not a credit late. it's a late to the mortgage company, you may pay $120 in a late fee, usually 4 or 5%, depending on the loan type. But that's not going to be on your credit report. You could pay a mortgage on the 30th of the month. It will not be a mortgage late on your credit. It'll be a late to the company. You'll pay them a fee and move on. But it won't be on the credit until it's 30 days late. So that's one thing I can tell you about late payments. Other than that, just make sure your bills are paid, right? When it comes to the utilization ratios, to recap on that, keep it under 30%. Optimal is 10 to 15. It's not a bad thing if you have a lot of credit cards to use the credit cards if you're building credit, because each time you make a positive payment towards a credit card, it's good. Why? Because you're telling the credit bureaus, hey, this person borrowed money and paid it back. So if you can borrow money on 5 credit cards and pay all of them back, it's better than only borrowing money on 1 credit card. It adds to the credibility aspect, right? So keep your balances low relative to the limits and attempt to increase your limits a little bit every couple of months, and just keep doing it for as long as you want. Do it for years, and you will see that in due time, you will have crazy high limits where you don't even have to worry about staying at 30% because your limits are so high. There's no need to worry. If I want to go on vacation with a $40,000 credit card, we'll spend $6,000. My credit won't be hurt in any way. You just use it. You don't have to worry. Yeah.
Someday you go someplace
Right.
nice, you can splurge.
That's it. Yeah, you just keep on doing it a little bit. You can call or you can do it online. But remember, having the high limits is not about having high. It's not about using them. Having high limits is so that you can use your credit card normally, and it doesn't affect the utilization ratio. But also, what if you lose your job? What if something happens? You get sick, you get this, you get that. These are tools. It's better to have $300,000 in available credit than having $2,000 in available credit. Why? Because if you lose your job and your kid gets sick and then your car breaks down, you could just use your credit cards to buy food, pay for get you through it. Okay? So having strong credit is an important thing to do in life. Okay?
That's at the bottom of the pie chart.
Well, the bottom right is the credit history, the length of time. So I will tell you something that can help your friend right off the bat. Anyone who has kids, they're 18, add them as an authorized user to your credit cards.
Oh,
Use a good credit card.
I'm not doing that.
Oh,
Get the card from them before you
yes.
do it.
Well, I'll tell you what. So let's
You
just
can
say,
add them.
let's just say this. Let's say I wanted to help your friend. I could take one of my credit cards that it's 20 years old, has a low balance relative to the limit, okay? No lates on it. It's being used, okay? And I can say, hey, let me get your friend's information. I'm going to add them to my credit card. Now, but not with an Amex. An Amex will show up as if it's a new account. Don't do this with American Express accounts, okay? With everything but American Express, okay? It will show up on their credit report as if it's 20 years old.
Oh, so it's good for them,
It's good
not
for the
for you.
15%.
It's good for
And
them.
they won't even get the card. The card will come to me. Why? Obviously, right? Why would you want a system where someone can
There you go.
get access to your
Okay.
credit card website and send themselves credit cards? So the credit card will come to me with their name on it. I can shred it. And now when I use my credit card, it will positively affect their personal credit. So a lot of people who help out their children is
Someone
usually
can
when we
help
see
their
it.
friends.
Yeah, they can add them on, like their parents. And listen, this person that adds them, so I could have a 500 credit score, a short sale, a foreclosure, a bankruptcy, but maybe I have, out of all of that, I kept one card with no lates, with a long-term history, with utilization ratio that's low. Even though my credit score is 500, this credit card, there's nothing wrong with it. And I can add that person to this credit card, and they will get all the positive benefits, but none of my negative benefits, right? Or whatever.
So maybe that's what she needs to jump
Yeah,
into.
That's a
long
shortcut.
term-
If there's someone
Just
A
don't do
long-
it with Amex, because Amex will show up as if it's
long-term
brand new.
situation.
Yeah.
It sounds like
Mhm.
she doesn't have any
That's a shortcut.
longevity.
That's a shortcut.
Yeah.
So
But in terms of
that,
a secured card, obviously the deposit.
but I like
From
Chime
that
better.
place-
I would say start with Chime. I'm going to tell you why Chime is great, because to come full circle, Chime is almost like a debit card. It has all the benefits of a credit card, but it's actually very similar to a debit card, because with Chime, you can reload it. So if you get a $500 standard secured credit card, you give them $500. Now you can use $500. If you want a higher credit card, you got to give them more of a deposit. If you want to give less of a deposit, you have a lower credit card. What do? Chime solves that problem, and I don't work for them. Maybe I should.
How does that in turn
Maybe I should do a
increase their
referral.
credit?
But I'll tell you, the way Chime works is you can use an app, and you can change your deposit as you go. Meaning, let's say you just got paid, you have $1,000. You don't want to use your debit card. Why? A million reasons. It's terrible to use your debit card. It doesn't help your credit at all. But also, if someone gets that credit card number, like let's say you're ordering a pizza, and you give them your debit card, they have a direct line to your bank account.
Yeah.
And they can use that debit card and they can spend, which happened to me once. You know why? Because I've been using these for a long time. And one time I went to a friend's house, family member's house actually, and I had my ID, an American Express, and my debit card in here. I offered to buy lunch for everyone, and the restaurant that we went to was a Turkish restaurant, did not take Amex. So I said, oh, well, I'll have to use my debit card. I don't have a choice. This is before the digital stuff. So I used 1 week later, I get a call. A Turkish website was just given $1,100 to buy something. Luckily, the company caught it. They called me. I just ordered food from a Turkish restaurant a week earlier. I know exactly where it came from. But the reality is they put my money on hold for a couple weeks as they figured it out. Now, thank God I didn't need it. The only thing I could think about was me, like most people, at one point in time, I would have been devastated to have $1,100 of my money completely locked down. So anyone who doesn't have, reserves and they're using their debit card, that's really dangerous because at any time, yeah, you'll get your money back, but there could be a period of time where your rent is due, you have no food in the house, and all of your cash is locked up because you gave your debit card out.
The moral of the story, eat Chinese food.
Eat Chinese food. Yeah, debit cards are dangerous. But if you use a Chime card, when you get your cash, instead of using your debit card, you could use you load up the Chime card. Say I got 1,000, put the 1,000 in Chime. As you use it, the 1,000 will go down to 900. So it's like you're using it like a debit card, but it is reporting, and it can never ever be late because you can only use the money that you already put in a deposit. It deducts it, and you can set it up. I've actually done it myself because I thought, I wanted to test it. I heard everyone tell me about it. I've tested this. That's why I'm pushing it. It will count down, and you can set it up where it will use if you don't want to make the payment at the end of the month, it'll just take the deposit. So basically, you can never make a late payment. It is really good. I would highly suggest Chime versus your credit card.
Then how does that later on translate into the credit increasing or being able to get credit from it?
So that is not the type of card where you can do that.
Oh.
That will help you build credit so that you can ultimately, because that's not like the best card to have.
Yeah.
You know?
You definitely have
Right.
two options. Either
That's a building your credit card. Another thing you can do is a collateralized loan. So if you want to write down I forgot the website. I don't think it's self.com, but look up a self credit card, self collateralized loan. This is for someone building their credit. You can get a loan. Let's say you want to get a $200 loan. It actually works the opposite. That's why they'll give it to you no matter what. Huh? Self.inc. Try self.inc. They also have their own secured credit card, but it's not like Chime. It doesn't do the deposit.
INC.
Yep, INC.
Not INK.
Yeah, not
With self, you can do you know what? Maybe I'll sell everyone a code or something like that. I think I can $10 a deal, but something like that, referral code. But I'll tell you, you can do a prepaid loan not a prepaid loan, but it is a prepaid loan. So let's say I want a $200 loan, and I want to have a 3-year loan where I'm paying maybe a little more than 200. Let's say $25 a month, okay, for 3 years. So normally you would apply for a loan. What happens? They give you the money now. You pay it back for 3 years. This does the opposite. You pay them for 3 years. Then they'll give you the money at the end. Okay, so what happens is it means that you'll definitely get the loan because just like the credit cards, they're not giving you anything. You're just paying them for a few years, and then at the end they'll give you the cash. So what happens is you're able to build credit because you're paying off a loan. Okay, even though you didn't get the money yet, you can make the payment so small, but it still helps because you're paying a bill.
Elijah, do we have any
Uh,
questions?
Yeah, we've been talking for a while, but I heard a lot.
questions.
No questions?
Cool.
So we're gonna follow up with some sort of cheat sheet.
Sure. Yeah, we can put some tips together. I mean, listen,
Or
it's,
something.
yeah, it's
that-
expensive. If anyone wants to reach out, I mean, I know Damoon's always sending out the info, feel free to reach out.
Along with this photo and the no, I think people really do like to see, who they're dealing with, and that's.
Yeah, we can
I
definitely do
have
that.
of us have, business cards with our face on it. But with definitely all of his, information and phone numbers so that we can hand it out as realtors.
Yeah, we can definitely do
I
that.
think
And,
that's for the client.
and for,
Yeah, it's, it proves the benefit of using us. Not that we know everything, but we can get them to someone who knows. It's the same thing with, the real estate attorney, lenders, we are the resource to get everyone, we work with, sellers, buyers, tenants, landlords, to all of the right resources. So
yeah,
thank you. Thank you.
absolutely,
Thank
happy to help. And I would say
It's always a
big key
good class.
takeaways